Hi everyone, thanks so much for watching. Okay, in today's video we're going to talk a little bit about present value and future value, or the concept of time value and money. We're going to illustrate this using life design analysis, and again, this is a fantastic tool. If you're not using this with your clients, again, navigate to our website, lifedesignanalysis.com. Sign up free for our 30-day free trial. We don't even ask for credit card up front. Try it with a few clients, see the impact, increase your sales, save some time, and go from there. Today's case, we want to show basically, how present value works. So again, a lot of people tell me, we hear rave reviews about our software, but one of the things we tell is that when people are using our needs analysis, they say, when I show people inflation and how big a piece of the pie that is, while you may need $1 million today, $1 million in the future is not going to do the same. Or some people will say, well, term renewals, sure, they go up, but because the value of the dollar in the future is not the same, how do we really kind of account for that? Or how do we show time value of money when it deals with insurance? Well, Life Design Analysis has a great feature called the Present Value feature, or Show PV, and again, it uses FV as well. So what I'm going to do is I'm going to set up a brand new case here. I'm going to set it up for Charlie Robb here. He is a 50-year-old male non-smoker, but again, this works with any client, any age. I'm going to focus on $1 million of insurance benefit. And what I want to show here is, first I'm going to start off really simple with just a very simple term product. So I'm going to say, let's search the market for term 10 here. And if we needed $1 million in the future, or if we needed $1 million today, how would that impact us in the future? And I'll use Equitable Life, they're top of the survey here for me, so I'm going to add them to the case. So, usually when people ask me, well, what does present value mean, or what does future value mean? I kind of relate it to a chocolate bar. And, maybe I'm dating myself a little bit here, but when I was a kid, a chocolate bar was $1. And now it seems like if I go and get a chocolate bar at the store, they're $1.87. So if I had to promise you a chocolate bar in the future, I wouldn't just budget $1.87. I'd have to budget probably something more like $3. And the same is true with insurance. If you need $1 million today to cover certain liabilities, in the future, that $1 million won't buy the same, so you should probably budget a little bit more. And again, that would be called time value of money. So you can see here we've got our term 10. We've brought in the renewal schedule here. All the insurance benefit we have here is $1 million. There's this one great feature here in Life Design Analysis, and again, it's called Calculate with Present Value. And if you just turn it to yes, you can actually set the R value in it, or the discount rate as it's called, in that PV calculation. And I've set mine at 1.5 here because that's pretty much what kind of the current inflation is. A lot of people would say if you're looking out long term, and again, just to kind of give some context around this, video was done in 2016. You may want to set it even at 2% or something like that, accounting for some inflation going up. But really, what we want to show is that if the need is truly $1 million, how is that $1 million, what is it going to be worth in terms of today's dollars in the future? So how does it get impacted? And again, I really want to show this as a concept of how you can sell, maybe some whole life or something with inflation protection. So again, we can either add to that face value, and again, that's going to help us protect our clients for their actual need, but it's also going to increase our FYC. So again, that's that win-win we're looking for. Or again, it could be an opportunity to present something like with a paid-up addition, where our insurance benefit is growing, and that is helping us fight inflation. So we're going to start off really simply. I'm putting in a term 10. Again, we search with $1 million of insurance benefit. We're going to look at it till age 99, or really 85 when it expires, but we're going to give it an inflation rate of 1.5. And we're going to see, how does inflation impact, if we actually need $1 million in the future, is that going to work when we think about inflation? So I'm going to generate my report, and we're going to see a little bit about how time value of money and future value of insurance actually impacts, and how we can use this with our clients to help really show how much true insurance we really need. So again, my premium schedule here is not adjusted for present value, you can see. But I have adjusted my premium schedule here for present value. So on the one side of the coin is that, sure, we can buy cheap term 10 now, and while that renewal in the future is quite a bit more substantial, because money is not worth quite as much, again, that inflation says, well, even if the renewal is 10 times as much, a chocolate bar may be $3 by then. So, money's not quite worth as much in the future. So it's worth more today. So again, it's adjusted for that inflation. That's why you see that kind of tilted value here. And again, it's going to sum the premiums accordingly. But the same thing is true about insurance benefits. So while $1 million, today buys $1 million worth of items, In the future, it doesn't. So if we adjust it for the present value of those future items, again, you can see that, when we're age, let's say 80, that $1 million in today's terms only has a buying power of really $640,000. So if we need to cover $1 million of liability, we might need something more like $1.4 million of insurance. And again, that's going to help you protect your clients for that inflation factor of the purchasing power of the dollar going down, but it's also going to help upsell a little bit more insurance for you and add to that FYC. So again, it's important for clients to understand that inflation does play a role in their actual need and to show them how much it does impact them. But again, it can be an opportunity as well for an upsell. Now, let's take this concept a little bit further. Let's go back to this case. And again, let's add and watch what happens when we add a whole life product. So I'm just going to add a Sun Life whole life. I've gone ahead and actually drawn up a quote for, again, the same thing, $1 million on a 15 pay. I'm just going to import it here. And I'm going to add it to the case here. So, with the paid up additions, one thing that's really neat is that, of course, it's growing our insurance benefit, and a lot of us think that's fantastic. What we don't really think about is how that can impact our present value. So when I generate this report here, again, what we're going to see is that, yes, the term, that term face value of $1 million is actually being eroded by inflation every single year. Same as that chocolate bar example. It used to be $1 and now it's $1.87. So again, if I promised you a chocolate bar, well, I would have actually had to budget a lot more money. Well, the same thing is true again with the whole life product. But what we're going to see, and again, when we adjust here for present value, we're going to see that, while that term started at $1 million and again gets eroded by that inflation, the whole life not so much. And again, it is eroded, but because the paid up additions are constantly fighting it, around life expectancy, we're still keeping that $1 million of insurance. Again, if I flip back here just to put it in context and see how much the extra paid up additions do grow, again, it's going to be quite neat to actually see. So again, if I take off this present value here and regenerate it, we're going to see some neat things. So just to kind of contrast it here. So again, that's one way you can use present value to either upsell, but really help better communicate to your clients. Again, we see a lot more robust cash value. And again, instead of being right around that $1 million, we can see that there's 1.5, it actually grows an insurance benefit. So, a lot of people think paid up insurance is great, and it really is. One of the best things about it is that it fights that inflation factor. So, that's one way you can use the PV metric to your benefit. So hopefully that helps. Thanks so much for watching.